Wizard, have you ever stopped to think about why some people seem to understand the stock market as if it were a game of chess, while others feel completely lost? The truth is, investing doesn't have to be a mystery reserved for a few enlightened individuals. In reality, with a bit of knowledge and the right strategies, anyone can start building their wealth and achieving the long-sought financial freedom. And that's where Peter Lynch comes in, one of the most renowned investors of all time, who demystified the stock market with a practical and accessible approach. Lynch shows us that you don't need a PhD in economics to be successful. Often, you just need to observe the world around you and use common sense. Want to discover how to turn your daily experiences into investment opportunities? Or understand how to choose stocks that not only grow but also pay consistent dividends? If you've ever wondered if it's possible to make money and even retire earlier by investing in stocks, this guide is for you. Let's explore together the lessons from Peter Lynch, discover how you can apply these principles in your daily life, and finally demystify the stock market. Stock market accessibility. Many people are intimidated by the thought of investing in the stock market, but the truth is that anyone can succeed in this endeavor. The secret is to stay calm and do basic research. Imagine it's like planning a trip. You don't need to be an expert to choose a destination, just know what you like and how much you can spend. The stock market works in a similar way. With a bit of patience and study, you can find good opportunities to grow your wealth and achieve financial freedom. And best of all, you don't need a fortune to get started. Peter Lynch, one of the greatest investors of all time, always emphasized the importance of not being intimidated by the market. He believes that the true power of investing is within everyone's reach, regardless of the size of your initial capital. Imagine, for example, that you like technology. With a bit of research, you might discover that stocks of technology companies, like Apple or Microsoft, have growth potential. It's like planting a tree. You need to wait a bit to reap the fruits, but when you do, the passive income and dividends can be very rewarding. Moreover, it's crucial to remember that the stock market isn't exclusive to the rich or the most knowledgeable. With the advent of the internet and online investment platforms, investing has never been more accessible. Just a click away to buy a stock and start your financial planning for retirement. Think of it as a way to cultivate your financial freedom, creating a stock portfolio that can grow over time, generating sustainable wealth, and allowing you to retire securely. So, are you ready to discover the next step in your investment journey? Lynch's track record. Peter Lynch is a name that resonates strongly in the investment world, and it's no surprise. As the manager of the Fidelity Magellan Fund, he managed to turn the fund into a true wealth-generating machine. Imagine, during his time at the helm of the fund, he delivered annual returns of 29%, which is simply impressive. Lynch's secret? He was never a proponent of trying to predict the market, something known as market timing. Instead, he focused on choosing good stocks, those that truly had potential to grow and generate dividends. This focus on stock picking is what made Lynch stand out. He wasn't so concerned with daily market fluctuations, but rather with the quality of the companies he invested in. Think of companies like Coca-Cola, which he identified as an opportunity before it became the giant it is today. Lynch saw value in companies that often went unnoticed by major investors. This teaches us that, with the right knowledge and a good dose of patience, it's possible to find hidden gems in the market that can significantly contribute to your financial freedom. Another valuable lesson we can learn from Lynch's success is the importance of long-term financial planning. He shows us that with a well-defined strategy and a keen eye for opportunities, it's possible to build a robust portfolio that not only generates passive income but also provides security for the future. After all, who wouldn't want to retire peacefully, knowing they made smart choices? And speaking of choices, let's explore more about the power of long-term investments in the next topic. Power of compounding. The power of compound interest is one of the most impressive forces in the world of investments. Peter Lynch always emphasized that time is one of an investor's greatest allies. Think of it as planting a tree. You plant a small seed and, with time and patience, it becomes a large fruit-bearing tree. Similarly, investing in quality stocks and reinvesting the dividends received can result in exponential growth of your wealth. And the best part is that this can be achieved without the need for large sums of money. Over time, these investments can outperform other forms of investment, such as bonds or savings accounts. Lynch also highlighted that, despite its volatility, the stock market generally outperforms other forms of investment in the long run. This is particularly relevant for those seeking financial freedom and a comfortable retirement. For example, if someone had invested a small amount in companies like Amazon or Google at the beginning of their journeys, they would be reaping the rewards of that investment today. These examples show how the stock market can be a powerful tool for wealth creation, especially when you have a long-term perspective and the patience to let investments grow. The real secret to harnessing the power of compound interest is maintaining a long-term perspective. Instead of trying to guess the highs and lows of the market, the focus should be on choosing stocks of solid companies, which have growth potential and pay regular dividends. This creates passive income that can be reinvested, further increasing the return potential. Thus, over time, you not only build wealth but also create a solid foundation for a comfortable retirement. And with that, we can move on to the next topic, which addresses the challenges and realities of the stock market. Volatility and risk. Investing in the stock market can be compared to a roller coaster with its ups and downs. Peter Lynch was always clear in saying that volatility is an inherent characteristic of this market. This means that stock prices can rise and fall dramatically in short periods. However, this volatility should not be seen as something negative, but as an opportunity. For example, market downturns can be a chance to buy shares of solid companies at lower prices, a strategy that can be very effective for those looking to grow their wealth in the long term. It is crucial to understand that the stock market is not a place for short-term money. Lynch emphasized that you should never invest money that will be needed in the next 5 years. This caution is essential to avoid impulsive sales during downturns, which can lead to losses. Think of it like a long journey. If you need the money to pay bills next month, it's better to keep it in a safer place. Volatility, while it can be unsettling, is part of the path to achieving financial freedom and ensuring a comfortable retirement, especially when you have a diversified portfolio that includes dividend-paying stocks. Additionally, Lynch advises that investors should have a cool-headed attitude and not be swayed by panic. Emotions can be one of the biggest enemies of a successful investor. For example, in past crises, those who remained calm and held onto their stocks often ended up faring much better than those who sold in panic. The key is to have a well-defined strategy and stick to it, even in times of turbulence. Now, let's explore how Lynch categorized stocks, helping to identify opportunities amidst this volatility. Investment strategies. Peter Lynch was a master at simplifying the complex world of investing. He categorized stocks into 5 main types: fast growers, slow growers, cyclicals, turnarounds, and asset plays. Each category has its own characteristics and investment strategies. For example, fast growers are companies experiencing rapid growth, such as tech startups, which can offer high returns but also come with higher risk. Slow growers, on the other hand, are more stable companies, like utility companies, that provide a steady passive income through dividends, ideal for those seeking a comfortable retirement. Cyclical stocks are those that follow economic cycles, such as the automotive or construction industries. Lynch recommended investing in them when the economy was down, to reap the rewards when recovery came. Turnarounds are companies that have faced difficulties but have the potential to recover and grow again. A classic example would be Chrysler, which, after nearly going bankrupt, managed to reinvent itself and thrive. Finally, asset plays are companies whose real value lies in their assets, such as real estate or patents, rather than in their core businesses. A savvy investor can identify these hidden gems and benefit greatly when the market finally recognizes their value. Lynch taught that understanding these categories and identifying where each company fits is crucial for a successful investment strategy. He also emphasized the importance of diversifying the portfolio among these categories to balance risk and return potential. This is particularly important for those seeking financial freedom and long-term security. After all, a well-diversified portfolio not only protects against market fluctuations, but also maximizes profit opportunities. And speaking of opportunities, let's explore the next topic, which discusses how local knowledge can be a major advantage in the world of investing. Local knowledge advantage. Peter Lynch always advocated that an attentive investor could find great investment opportunities simply by observing their daily life. He called this the local knowledge advantage. The idea is simple. As a consumer or someone embedded in a particular community or industry, you can identify trends and promising products before Wall Street analysts do. For example, Lynch mentioned that a mother who notices the increasing popularity of a diaper brand could investigate the company behind that product. If the company is solid, it could be a great investment opportunity. This practical approach is especially useful for those who are not financial experts but want to build wealth and achieve financial freedom. For instance, if you frequent a restaurant that is always crowded with long wait times, this might be a sign that the company is doing well and could be a good investment. Lynch illustrated this strategy with cases like Volvo, where consumers who noticed the growing popularity and quality of the cars could investigate the company's stock before the market recognized the growth potential. Additionally, local knowledge is not limited to observing consumer trends. It can also include insights into regional economic conditions, government policies, or even technological changes. This can give investors a significant edge in assessing a company's real value. The key is always to conduct thorough research and not be swayed by enthusiasm alone. And speaking of enthusiasm, the next topic will address how maintaining a long-term perspective is essential for success in the stock market. Long-term perspective. Maintaining a long-term perspective is one of the cornerstones of Peter Lynch's investment philosophy. He always emphasized that investing in the stock market is like planting a tree. You shouldn't expect immediate fruits, but rather cultivate patiently until it grows and produces. This means resisting the temptation to sell stocks hastily during periods of volatility. The stories of companies like McDonald's and Chrysler illustrate this point well. Both faced challenges at different times, but those who held onto their shares and collected dividends over time were ultimately rewarded with substantial returns. This long-term approach also applies to building a solid foundation for retirement. Lynch pointed out that by choosing stocks of solid companies and holding them for years, you benefit not only from the growth in stock value but also from a steady passive income through dividends. This is crucial for those seeking financial freedom and a comfortable retirement without relying solely on traditional income sources. A practical example is investing in consumer staples companies, which tend to be resilient even during economic downturns, thus ensuring a stable source of dividends. Adopting this long-term mindset requires a certain amount of patience and discipline, characteristics that are not always easy to maintain, especially in the face of often sensationalist market news. But, as Lynch liked to say, the stock market is a mechanism for transferring wealth from the impatient to the patient. Therefore, the real challenge is to stay calm and trust your financial planning. Speaking of planning, let's now explore the importance of understanding a company's financial health, a crucial step for any investor. Importance of balance sheets. Peter Lynch always stressed the importance of understanding a company's financial health before investing. He believed that a thorough analysis of financial statements is essential to assess the true value of a stock. Imagine you are buying a house. Wouldn't you want to know if you are buying it at a good value or if it's just for show? Similarly, when looking at a company, it is crucial to check if it has a solid financial foundation. This includes examining cash flow, cash reserves, and debt levels. Companies with high levels of debt may face difficulties during economic crises, while those with strong cash reserves have more flexibility to grow and innovate. Understanding financial statements is not just about numbers. It's about grasping how well a company can sustain and increase its dividends over time. Lynch pointed out that companies with strong cash reserves and low debt are better positioned to offer consistent dividends and even increase them. This is particularly relevant for investors seeking a stable passive income to achieve financial freedom and secure retirement. Companies like Johnson & Johnson and Procter & Gamble are examples of firms with solid balance sheets that have a long history of dividend payments. Additionally, Lynch always advised looking beyond the numbers and considering the industry context and economic conditions. For example, a technology company might have high capital expenditures due to investments in research and development, which might seem alarming at first. However, these investments may be essential to keep the company competitive and innovative. Therefore, when evaluating a company, it's important to consider both the numbers and the broader context. Now, let's dive into dividend analysis, a powerful tool for measuring a company's financial health. Dividend analysis. Dividend analysis is a valuable tool for any investor interested in understanding a company's financial health. Peter Lynch always highlighted that dividends are not just a form of return for shareholders, but also a sign of financial strength. Companies that can consistently pay and increase dividends over time demonstrate effective management and a robust business model. For example, companies like Coca-Cola and Microsoft are known for their stable dividend policies, providing reliable passive income for their investors. This consistency is especially important for those seeking financial freedom and a comfortable retirement. In addition to offering passive income, dividends can also be a way to assess a company's commitment to its shareholders. Lynch pointed out that companies that regularly pay dividends tend to be more transparent and responsible with their finances. This is because, to maintain dividends, they need to have prudent financial management and consistent cash generation. Thus, when analyzing a company, it's important to look at not only the dividend amount but also its sustainability. This can be done by calculating the payout ratio, which shows the percentage of profits being distributed as dividends. A healthy payout ratio generally indicates that the company is balancing its growth needs and returns to shareholders well. Finally, Lynch emphasized that dividends can serve as a safety cushion during periods of market volatility. When stock prices drop, dividends continue to provide returns, which can help cushion the impacts of market fluctuations. This is especially relevant for long-term investors who rely on this income for their financial planning. With this perspective, we can better understand how to use our knowledge and personal experiences in analyzing companies, an essential aspect of becoming a successful investor. Research and emotional strength. Investing in the stock market requires more than just technical knowledge. It also demands a good dose of emotional strength. Peter Lynch always emphasized that the stock market is like a roller coaster, with ups and downs that can test even the most experienced investors. To navigate this volatility, Lynch suggested that investors use their own experiences and everyday observations as a basis for their research. For example, if you notice that a new supermarket chain is always crowded, it could be an indicator of success worth investigating further. This practical and straightforward approach helps create a more personal connection with investments, making it easier to withstand emotional fluctuations. Research is crucial, but the ability to stay calm and disciplined during uncertain periods is what truly distinguishes successful investors from the rest. Lynch used to say that the best action to take during a market drop is to do nothing, indicating the importance of not reacting impulsively to news or short-term fluctuations. The idea is to trust your financial planning and the quality of your investment choices, even when the market seems turbulent. This emotional control is crucial for maintaining a long-term perspective and leveraging the power of compound interest and dividends over time. Finally, Lynch encouraged investors to continuously educate themselves and stay informed about their companies of interest. Reading annual reports, following industry news, and even visiting stores or talking to consumers can provide valuable insights. This type of hands-on research and direct engagement with companies allows investors to develop a deeper and more intuitive understanding of the market, which can be a significant advantage. Are you ready to transform the way you view the stock market? Are you willing to step out of your comfort zone and start investing intelligently? How about taking the first step today? Look around, Wizard, use your local knowledge, and start spotting opportunities. Remember, success in the stock market is not just for Wall Street's big investors. It's for anyone willing to learn and apply what they've learned. And if you want to keep learning and improving on this journey, subscribe to our channel and turn on notifications. This way, you won't miss any upcoming content that can help you achieve your financial goals.